Welcome to today's class. Today we are going to do financial accounting and our topic is double entry bookkeeping. Now, what do we mean by double entry bookkeeping? Double entry bookkeeping states that all transactions must be recorded in two places to maintain an accounting equation. What does this mean? It means that every transaction that affects assets, liabilities, capital, income, or expenses must have an offsetting effect. The account must balance. If it doesn't balance, that means it is not correct. That takes us to bookkeeping. What is this bookkeeping? Bookkeeping is the process of recording financial transactions in the account records of an entity. There is usually a separate account for each or the different types of accounts. These accounts are kept together in a ledger known as general ledger, main ledger, or nominal ledger. A ledger is a collection of related accounts. What does that mean? It means that for each type of asset, liability, income, expense, and owner's capital or equity, there is usually an account for them. Now we don't just place these accounts anywhere we like. No, there are basic rules that every accountant has to use for this double entry bookkeeping. We don't just see one account and take it and place it wherever we like. No. Now these basic rules are divided into two. We have the debit and credit entries and T account basic rules, and then we have, let's start from the debit and entries and T accounts. Now, all financial transactions are recorded in the account in accordance with a set of rules. These rules are: every transaction must be recorded twice. That is, one as a debit entry and in another account as a credit entry. The second rule is that total debit entries and total credit entries must be equal. If they are not equal, then you know that your account is not correct. Know these two rules because you have to apply them constantly when accounting. Then that takes us to the T account. T account is just something that is very simple. It's just using the T as a T diagram. The T account is a shape of T, and all debit entries are made in the left hand side while credit entries are made in the right hand side. That is just the T account. We have an illustration there where we will see the debit side and then the credit side, which is symbolized with DR for debit side and CR for credit side. Then we have our account names on top. Let's go to the rules of debit and credit. In the general account, there are accounts for assets, liabilities, equity, income, and expense. Now we have to understand what these assets, liabilities, equity, income, and expenses are. Although we've done that before, but we'll go through them again so that during application we would put them into cognizance. Now, assets. Assets is an economic resource that has potential to produce economic benefits. An example is a building. A building is an asset, which means that it might produce economic benefit like rent. Now we have liability. Liability is the present obligation of an entity to transfer an economic resource as a result of past events. Simple layman English: liability is money you are to pay to someone or to another business or to another entity because the business gave you something in return. That is liability. And it takes us to equity. What is equity? Equity is a residual interest in an entity after the value of all its liabilities has been deducted from the value of all its assets. A residual interest in an entity after the value of all its liabilities has been deducted from the value of all its assets. That takes us to income. An income is an increase in assets, decrease in liabilities, or increase in equity. That is an income. And expenses are decrease in assets, increase in liabilities that results to decrease in equity. Now let's go to the rules of debit side. When do we record a transaction on the debit side? When do we say yes, this transaction belongs to the debit side? First, that transaction has to be an increase in an asset. An increase, if it is an increase in an asset, it belongs to the debit entry or the debit side of the account. If it is now an increase in an expense, what does that tell us? Tell us that it also belongs to the debit side of the account. It is a decrease in liabilities. It belongs to the debit side of the account. When we say decrease in liabilities, what do we mean? For example, my company is owing another company 10,000 naira, and then I paid that company 5,000 naira. That company I was owing that company 10,000 naira, which was the liability, paying 5,000 naira now. That 5,000 naira I paid will be on the debit side because I've decreased that liability. I hope it is understood. Then a decrease in an income is also should also be on the debit side. A decrease in capital should be on the debit side. We are going to use this continually in financial equation. So if you do not understand, you pose the questions to us and we will give you feedback. Now, let's go to rules of credit side. What will make a transaction to be on the credit side? Just like the debit side, the credit side is the opposite of the debit side. Remember, in the debit side, we said that when it is an increase in an asset, it should be on the debit side. But the credit side, when there is a decrease in an asset, it should be on the credit side. When there is also a decrease in expenses, it should be on the credit side. When there is an increase in the liability, it should be on the credit side. When there is an increase in an income, it should be on the credit side. Where there is an increase in capital, this should also be on the credit side. Let's go to illustration to understand what I am trying to explain. A purchase invoice is received for a motor van for 10,000 naira. For 10,000 naira. The double entry, the double entry will now be the motor van is receiving the 10,000 naira. So what happens? You what? Debit motor van because it is an increase in what? Expenses. And then you credit trade payables because it is an increase in liability. The motor van is the 10,000 naira, it's a liability. Now look at our T diagram where we debit motor van, which is the trade payables, and then we go to our expenses payables and we credit motor van expense. Have you seen the difference now? In motor van account, we debit the trade payables. Now, whatsoever is written here, we give us the opposite here. Here, we are told to debit motor van because it's an increase in expense. That's what we debit. The motor van account will now debit it. Then the expense payables, the motor van expense, we credit it. Now we see others for us to actually really understand this. Let's continue. You can also write it as debit motor van expense 10,000 naira, or you credit payables 10,000 naira. That will take us to double entry bookkeeping and cash account. Now, every entity or an entity is expected to keep separate accounts to record cash. One is for cash in hand and the other for cash at bank. Now, this also has rules which we must follow. The cash at bank is an asset account, so it must always be in the debit column. An asset account, that means once it is increasing, it is in debit account. Once it is decreasing, should be in the what? Credit account. In case you are writing, or yes, in case you are computing a financial statement of account, you should know that cash at bank should be in the asset account. Then receipts of cash are recorded as a debit entry in the cash at bank account. Any receipt of cash, they are recorded as a debit entry in the cash at bank account. Then payments of cash are recorded at the credit entry. When you pay cash, that means cash is leaving. When you receive cash is coming in. It must be at the debit side. But when you pay cash, it is going out. So it must be at the credit entry in the cash at bank account. Now, what should increase cash and what should reduce cash? Let's start from what should increase cash. Sales account for cash sales increases cash. When you sell something, the money is coming in, so it increases what? Cash. Total trade receivables account for payment received from credit customers. Receivable account, payments received, they are usually written in the receivable account, so it's what? It increases cash. Then capital account for new capital introduced by the owner in form of cash also increases cash. Now let's go to what reduces or decreases cash. I hope you are following. If you are not, you can please go back again and listen. But if you are still confused after this, you can always send us a message and we will be pleased to put you through again. We are always there for you. Now let's go to what reduces cash. I believe we are there. Good. Expense account for payments of cash reduces what? Cash. Expense account you give out. Trade payables account for payment of suppliers. Trade payables is money owed by the company to other people, the money the company has to pay. Then a payment in cash for new assets reduces cash. A drawing account by the business owner also reduces cash. I hope that is understood. Now let's go to examples. We're just going to take 5 examples, and after that I expect you to be able to do the rest. I'm going to explain them as calmly and the best way I feel, and then I believe you should be able to follow up and solve the rest. Let's look at our first example. Base introduces 15,000 naira as cash into a business. Base has introduced 50,000 naira as cash into the business. Now remember, double entry, we have to have 2 accounts. Is that not so? Now in these 2 accounts, one will be cash account, then the other will be capital account. Introducing cash into the business is capital. What does this mean? The cash of the business has increased and the capital too has also increased. Please let us remember, capital is always liability. Capital is money the organization owes to the owner of the business. It is always liability. And what do we do to liabilities? We credit liability. Is that not so? Liabilities should be credited when they increase. When they increase, you credit liability. When they decrease, you debit liability. Now bank, that is cash. Cash also what? Increase. Is that not so? You debit bank, bank can replace cash, cash can replace bank. You debit bank, that is 15,000 naira, and then you credit capital. Remember what I told you about cash? Do you remember? I said that what provides my cash to increase is what? Capital account for new capital introduced. If we go back here, we'll see it. Yes, capital account for new capital introduced by the owner in form of cash. We make it to what? Increase, which we may put it at the debit side. I believe that is understood. Which means we have our 2 accounts here. We have the capital account and then we have the bank account. In the capital account now, we credit what? Bank. And in the bank account, we debit what? Capital. I hope you have seen it. I tried to explain it before, why it should be capital here and why it should be bank under the capital account and why it should be capital under the bank account. You interchange them. Now that being said, let's go to another one. Let's continue. Another example, we have gotten 2 accounts now, the bank account and the capital account. And then we are trying to create an account. So let's continue. Base now borrows 25,000 naira to purchase a van. He now borrows 25,000 naira to purchase a van. What does this mean? It means that There are 4 accounts here. I will explain. Calm down. I will explain. He borrows 25,000 naira. What does that mean? The bank will increase, cash will increase, bank will increase 25,000 naira. And then loan, because he's borrowing. Loan, we have to credit loan. That is 2 sets of what? Account. And then they did not stop there. They said the 25,000 naira was to purchase a van. What does that tell us? It tells us that we now debit van, because van is the one receiving, and then we credit bank because bank is now giving. Okay, let me come again. Base borrows 25,000 naira. 25,000 naira will now be given to bank, money borrowed. And then the borrow will be a loan account, which means loan is giving bank 25,000 naira. So you debit bank and credit loan. And then we have another account there which says that the 25,000 naira is now used to purchase a van. What does that tell us? We do what? Debit van. Van is the one receiving the money, and then credit bank, because bank is now giving that same 25,000 naira out. Let's look at the account, which now says bank account. We have already had bank account before. Remember, capital and cash. I hope you remember that. So we don't need to draw up another account for bank. We continue using that same account. It is when it's a fresh account that has not been there, that is when we draw up a new account. Now let's look at it. Bank has already been given. That is the loan. That means, what did we say we will do? In our bank, we debit bank 25,000 naira for loan. That means loan 25,000 naira. And then loan account, we credit what? Loan. That is bank 25,000 naira. Then we also said that we debit van 25,000 naira. That means in bank account we have van 25,000 naira, and then we credit bank 25,000 naira. That means we have another account which is van account, bank 25,000 naira. I hope that is understood. Now let's continue. Base rents a shop 20,000 naira. What do we do? The shop is the one receiving the money. So what happens? We debit shop, and then bank is the one giving the money. We credit bank. That brings us to our account. We'll continue with our bank account, since we already have bank account, and then we'll open a new account for shop account. What does that tell us? Shop will now be 2,000 naira, and then in shop account, in the debit side, we write bank 2,000 naira. I believe that is well understood. Let's continue with number 4. Base purchases inventory for 18,000 naira on credit. Now, inventories don't have their own account. Inventories are placed under trade payables on double entry account, unless it is profit and loss account, statement of profit and loss account. Inventories do not have their own account. So yeah, we said base purchases inventory for 18,000 naira on credit. What do? Our purchases, we debit purchases for 18,000 because purchases is the one receiving, and then we credit bank 18,000 naira. Why are we crediting bank? It is on credit. That is trade payables now will now be what? 18,000 naira, and then the trade payables purchases 18,000 naira. The money is coming from bank. Then the last one, which is base, pays 10,000 naira to a supplier. pays 10,000 naira to a supplier or to the supplier. That means the money base the goods base had collected on credit. Base paid to 10,000 naira back to that supplier. What happens? We credit back and debit trade payables. Debit trade payables because the money has what? Reduced. Remember, reduction in liabilities should be in the debit account. Then we credit bank because money is leaving bank. What does that mean? It means that in bank now we have our trade payables, which is 10,000 naira, and then in trade payables we have our bank, which is 10,000 naira. If you discover, every debit account has a corresponding credit account. If it is not like that, that account is not correct. You check it again, you try to work it out again so that you know where your error is coming from. Now I had wanted to continue, but I said no. As intelligent students, or as intelligent as you are, I believe with what has been taught that you should be able to attempt these questions. So you attempt these questions. 1. Base sales inventory for 12,000 naira cash. You draw the double entry account for us. 2. Base sales inventory for 4,000 naira credit. 3. Base repays 10,000 naira of the loan taken. 4. Base pays his supplier 6,000 naira. 5. Base receives 8,000 naira of the money owed to him, that is trade receivables. Now you try to answer these questions, and if you cannot answer them, please go back again and listen to the notes and the explanations. Make sure that you answer them before you move to the next class. Have a wonderful day ahead.